Hello, class. Last time we talked about QuickBooks introduction. Today we're going to go over company file maintenance and setup. This process will allow you to create a new company through using the interview process or the 12-step process, and do some file and perform some file maintenance. It's a very, very important chapter to go through, so I'm going to try to take my time and go through it. It's not complicated, but it's some things are very important, and I want to highlight those as we proceed through this section. I'm going to put everything on the screen so you can take a look. We're going to perform a complete company file setup using the 12-step process. And when you go through this process, there's so much that you can learn with QuickBooks, but I think the most efficient way to learn it is to start with a fresh new company and with chart of accounts that you create. So we're going to use the easy step interview process, and this process is so incredibly easy. What it does is ask you some various questions, and it guides you step by step through the setup of a company. We're going to set up chart of accounts in the chart of account list, meaning we're going to use some of the chart of accounts that already exist for a particular company, but we're going to add a few. We're going to gather the information to set up opening balances, and we will enter opening balances. And we will enter year-to-date income and expenses. During the setup, we have to adjust our opening balances for sales tax payable, the same with inventory for quantities on hand, and verify opening balances. And definitely we will be dealing with opening balances for our equity and retained earnings. We will back up our file and set a closing date. The closing date is going to be the date that the month end or the year end closes. And we will optionally have the ability to set up users and passwords. So the 12-step process, it begins really with a start date and some important information about how to create a company file. Another part of it is accounts, start of accounts and lists. A chart of account is obviously the general ledger, which includes assets, liabilities, equity, revenue, and retained earnings. We're going to open beginning balances. Generally, not always, but when QuickBooks, you set up a new company, in QuickBooks, the company may already be established. So when I talk about opening balances, I'm talking about a company that's already been established, but for purposes of QuickBooks, it's new. So therefore, transactions may have occurred already that you may have to load in, and these are the opening balances. And we're going to enter some transactions that are outstanding. That some of them could be accounts payable checks that have not cleared the bank, or it could be some transactions that have not been paid, meaning invoices that you submitted to your customers, they have yet to pay them. So those items we're going to have to put in as well. And if necessary, depending on the date that we start entering data, you'll have to enter year-to-date income and expenses. And we can do that in several ways, through a journal entry or through just entering the actual transactions into the system. Sales tax payable, if applicable, generally something like this will have to be done when you set up a company. But we will create a sales tax payable account and also the various lists accompanying the sales tax payable. We establish inventory because this company not only provides a service, but it also sells a product, and those products are maintained in the inventory system within QuickBooks. We will set up payroll lists and year-to-date payroll information, and at the end, we will verify the trial balance. And opening equity balances will be entered as well. And this will allow the organization to have the framework of the company set up in QuickBooks in a very, very quick and step-by-step process. And in the end, we will do as we always do, back up our files to ensure that the files are maintained and kept safe. Now, starting a start date, generally organizations have a calendar year, but some do have fiscal years. And a fiscal year is going to be, it starts at the beginning of a year, like July to the end of June. And it's usually a rolling 12-month period, like, for example, July, August, September, all the way through June. A calendar year would obviously start in January and end in December. This is just a screenshot of what it looks like when you're in the actual interview step process, it does ask you a series of questions, are very good questions, and those questions guide you through the process. This list here that you're looking at is a list of companies or industries that you could select in their predefined database. Now, you do not have to use these options, but you will have many different industries that you can use, and it does make the process of establishing a new company far easier. So, in the setup of accounts, you'll need to have the account types, the numbers, adding accounts and sub-accounts. And sometimes sub-accounts are used to have subcategories, like telephone might have a subcategory like cell phone, VoIP, or other accounts that are sub to that. But we also can reorder our account list and remove accounts that we know we will not need. Our assets, as you know, is going to be our bank accounts, our accounts receivable, our other current assets. And other current assets include deposits. It includes short-term securities, those types of current assets. But we also will have fixed assets, which is long-term. And other assets could be something more of a long-term securities, something that you will, that you probably will not get money within or converted to cash within 60 days. Maybe it would be longer term. Then we have our liabilities, starting from the most the maturity date with most recent maturity dates. So we'll start with in order of maturity, starting with accounts payable, credit card, and loans, and then you have your other current liabilities, and then you'll have your long-term liabilities. And long-term generally is going to be debt, 30-year, 20-year, 10-year, 5-year debt. Equity, it's going to be, it depends on the organizational structure, but equity is generally going to be the partners, if it's a partnership, members, if it's an LLC, or in this case, retained earnings and stockholders' equity, and paid in capital if it's a corporation. So you'll have your income accounts and your other income. Other income is going to be income from non-operating sources. Interest revenue is one example of that. And then we have expenses, and then other expenses are generally going to be non-operating expenses, and those are going to be gains, losses would be possibly, or some other non-operating expenses. Cost of goods sold is also in that category. Now, generally, when you start, you need to ensure that certain preferences are set. The preferences that we set, and these categories range from accounting all the way down to 1099s at the bottom here. But these categories set the standards, set the preferences, set the defaults for various transactions, various events, and various procedures that you'll do in QuickBooks. So right now what we're doing is activating account numbers. This is not absolutely critical. You don't absolutely have to use account numbers, but it is important that if you do use account numbers that you require those account numbers to be used. So also if you click on use account numbers, also click require accounts. This makes its uniformity important, and when you generate reports, it will make running the reports much more accurate. So if you're going to choose to use accounts, be certain to require accounts when you enter transactions. And this is just an example of what a chart of account would look like, with various accounts ranging from the cash all the way down to the current liabilities, which is National Visa Gold. And this screen here is just as a screen that shows you how to enter, add, or even in some cases delete an account. And the categories include income, expense, or other. And here's a fixed asset, bank account, loan, credit card, etc. So when you add in a new account, you have to tell it what account type it needs to be, and that's critical. That you cannot add an account unless you tell it if it's going to be a revenue, expense, asset, or liability. And then on the side here, it says the account number. If you use account numbers, make certain that your numbering system is uniform. It's consistent, meaning one accounts generally are going to be asset, two accounts are generally going to be liabilities, three accounts generally going to be equity accounts, and 4 and 5 are going to be revenue and expenses respectively. Sometimes you'll have 6 as your expense accounts. It depends. Again, it depends on the organization. So for this particular illustration, they're going to have the account numbers to have a series starting with 600 and so forth. But again, so long as the account numbers are systematic and uniform and consistent with the assets and liabilities, expenses, equity, and revenues, it's okay. You're totally in control. Adding sub accounts does add some adds consistency with the account reporting, but also with telephone expense, for example, it might very well be much more efficient to not lump all your telephone expenses in one account. You may want to break them out, and this is again for reconciliation purposes or for tracking. You can delete accounts if you need to. And you can deactivate account. General practice would be to inactivate account that you may not need rather than deleting it. But if it's an error, obviously you want to delete it. And you can take counts and merge them together, and we can go through that process as well. Deleting the account should be your last option, but QuickBooks is quite easy to delete on an account that you've already created. And to add accounts, this is the existing account structure. So looking at the bottom half of the screen, you'll see account, activities, reports, and attach. Here we're going to add a new account, or we can delete an account, or we can edit an account that's already there in existence. And this lets you know that with an X that you want to delete this account. And you can make accounts inactive, meaning these accounts cannot be posted to. You can't post any transaction to an inactive account. And that may very well control errors and make certain that no one posts to an account they're not supposed to. You inactivate it, particularly when the account has a balance already there. If it's an asset account and has a balance, you don't want to delete it. And I don't think the system will let you delete it, but you can inactivate it and keep people from actually posting anything to those accounts. And reordering the list. And again, these little column headings give you the ability to reorder the list based on the criteria. It just matter if you're clicking onto it. If you can see here, the little arrow, and you can sort by name or without account numbers. And it's all about what your preferences are and how you want to view the information. So basically, starting information, you'll need to have your trial balance. And from your trial balance, it will guide what information you put into your accounts, whether it be bank accounts, whether it be other transactions, other outstanding invoices, and so forth. So when we're working on starting our account or our new company, what we'll need as a trial balance, we'll need a copy of a reconciliation, the most recent one, and a list of any open invoices that have not been paid. And if we have employees at this point, we'll have the employee list so that we can enter those as well. Payroll liabilities and other items. And if applicable, inventory items. Now, entering opening balance, you can enter them directly by editing the account in some cases, or you can use a journal entry to enter them. And most often, using a journal entry is the best way because it maintains the audit trail that we all need. So if you directly edit an account, all you need to do is at the bottom of the account edit mode, you just enter beginning balances. I do not recommend this, but it's good to know that you can. And the reason is you lose the audit trail. And you want to be able to show that those entries have been posted and they were posted correctly. This is the way that I would say GAAP would prefer you do it. But again, there's no right or wrong. It's just a question of preference and what you want to show in detail as you establish your account. But this is the way it's done here. If you want to enter all of the beginning balances, here you go, and you create adjusting journal entry to create all of your opening balance accounts. Opening balances for assets and liabilities will be offset against the equity account, and that's just letting you know when you put in items what's going to be the offset. We are talking about a double entry accounting, therefore a debit has to have a credit. And the final steps will be entering open items, including outstanding bills or other things of that sort. So as we proceed through this, we will find out that the most important part of entering transactions really begins with the interview process. And we will go through entering items into the system, but the more important part of all of this is ensuring that you have all the data you need to create your new company and set up the new balances. This will be the end of our interview process, and the end of our lecture. But I want you to go through this particular module very carefully because it takes a little bit of time and is very, very tedious. But it's a simple process and it's very straightforward. Thank you for listening.